Should you be maxing out your 401k? In this video, I'm going to share with you some tips so hopefully you can make the best decision. If we haven't met, I'm Tony Hansman with Guardian Financial, a wealth management firm, and we created this page to help people just like you in or near retirement. Please make sure to hit that like and subscribe button because things are always changing and we want you to stay in the know and not miss out. And I'll make sure to link everything that I talk about in the description box below. So let's go ahead and jump right into it. I've been doing financial planning for many years, and I want you to stay with me until the very end because I'm going to share the biggest mistake that most people make when saving for retirement. So the question is, should you be maxing out your 401k? First, everyone's situation is different, and maybe maxing out your 401k is best for your situation. But let me show you possibly a better strategy on the biggest future unknown, and that is taxes. What will taxes be in the future? Nobody knows for certain, but if you ask most people, they'll say they think taxes will be higher in the future. Now, we've all heard the line, when I retire, I'll be in a lower tax bracket. Maybe so. Say you were making X amount of dollars while working. Then you retire and you're making Y, which is less. You might be in a lower tax bracket. But is it possible that tax rates could possibly change in 5, 7, 10 years down the road, and the same amount of income that you're making after retirement, you could now be in a higher tax bracket? Absolutely. And if you've been maxing out or overfunding your 401k, this could be a big problem when it comes time deploying money out of your qualified accounts during retirement. I often see that most families' largest liquid asset is their 401k or it's an IRA. All of this money has never been taxed. And even if you don't need the money, you're forced to take it out in your 70s due to RMDs, what are called required minimum distribution. That's right, you're forced to take money out of your qualified accounts even if you don't want to, causing those dollars to be taxed. And if you don't take the RMDs, well, it's a hefty penalty. And that's not the worst part. When you're forced to take that money out of your IRAs, that goes on to your 1040 federal tax returns. And this can cause, along with other income, up to 85% of your Social Security to become taxable. It could be a double whammy or a tax bloodbath. So I encourage you to consider putting money more balanced between, number one, qualified money. That's what we've been talking about. Things like your 401k and your IRA. Those are tax deferred. Number two, after-tax accounts like your brokerage accounts. And number three, my absolute favorite, tax-free accounts like a Roth IRA. Now, in 2023, 401k contribution limits are $22,500. And catch up if you're 50 plus, another $7,500 for a total of $30,000. Now, less than 15% of people actually max out their 401k, but let's say, for simplicity, you want to save $15,000 this year. First, I want you to check to see how much your company 401k matches. Say, for your salary, you can put in $5,000 and they will match it. Well, you don't want to give up free money, so contribute up to the company match. If they will match 5, you're going to put in 5. And consider redirecting the other $10,000 of the $15,000 in this case. You want to save those between the Roth IRA and that after-tax brokerage account. In 2023, the Roth contribution limits are, pending you qualify, and 50 or older, is up to $7,500. And in this example, you could put in $5,000 into the Roth and the last $5,000 into that after-tax brokerage account, or some combination close to that. Maybe $5,000 into the 401k, at least up to that company match to get the free money, and say $7,500 into the Roth, and then the remaining into that after-tax account. This will give you a better balance when it comes to retirement of when and which account to take money from based on future tax rates. If it's a smaller IRA and if standard deductions are still around, having it just in an IRA, it might work. But for most people, in my opinion, having a better balance between those three accounts will set you up better than maxing out your 401k and hoping tax rates will always stay low. Remember, I'm not a CPA and I don't know your specific situation, and this is not specific financial advice. There's pros and cons to every investment and strategy. These are just something I wanted you to consider to see if it makes sense for your financial plan. If this was helpful, please make sure to hit that like and subscribe button. Then go check out our resource page right up here. Lots of great items to help you maximize your retirement. And don't forget to consult a licensed professional who understands your specific goals and dreams.